All right, let's go ahead and begin. Welcome. Today is Thursday, August 4th, 2022. It is Thursday. It is just afternoon here in New York City. Let's get down to business. First things first, I know what is on everybody's mind, especially if you are on social media, if you're on if you're watching the media or traditional media, HKD, right? Meme stocks, all right. Why am I even bringing up meme stocks? You guys who have been with me for a while, you guys know. I'm not a big fan of meme stocks. I hate participating in them. It's just not my thing. Even individual stocks, I sparingly get involved. But to get involved in something this sentiment driven, no thanks. But I think there's something important we can learn from meme stocks, from this price action right here. Okay, what does this all mean? The fact that this is even happening right now means that liquidity conditions are improving. Okay, financial conditions are actually improving. It's the liquidity and people being able to take risks is still quite high. All right. Why do I bring that up? I just think that all this tough talk from the Fed, they're doing this because they're seeing stuff like this. This is exactly what the Fed does not want to see. They don't want to see zombie companies or unproductive companies like this have these types of moments. It makes raising funds easier for these kind of companies. All right. I think that if meme stocks like HKD, all these meme stocks, if they start going up, and if this like reverses and it still keeps going up and it still makes the news and headlines, I think during Jackson Hole they're going to talk about this. They're going to say, hey, maybe we need to send a stronger messaging. Definitely, that's what I'm looking for. That's why I'm looking at this to even begin with. Is this going to have holding strength? Is this going to come back up? That just means that financial conditions are improving drastically. All right, the Fed miscalculated. All right. Perhaps they should have messaged a little bit more hawkish beforehand. But remember in the last few weeks, we've gone between periods of hawkishness, dovishness, right? At first in the beginning of June, remember they were saying, oh, we're gonna have to, raise rates even more. Financial conditions are good enough. Employment is low enough where we can actually, raise interest rates a little bit more. And then they said, then they pivoted a couple weeks after that. They said, ooh, well, maybe not. Maybe we don't need all those interest rate hikes. It looks like financial conditions are tightening. So they're going back and forth. And I think this is definitely a cause to get a little bit more hawkish. Okay, stuff like this shouldn't be happening if the Fed is doing what it can to stomp out inflation. Okay, if it's really trying to tighten, stuff like this shouldn't be happening. Okay, it's just the Fed. I mean, they're just not tightening. I think. This is my opinion, of course. This is my opinion. In my opinion, I don't think the Fed is doing enough to tighten. Look at what Volcker did. Look at how in the 1910s we got out of that inflationary period here in the United States. It just doesn't, this idea that you could try to do this with a soft landing, I think it's kind of ridiculous. No time in history has great inflation, or hyperinflation or whatever you want to call it, inflation that's higher than usual. No time in history has that been solved just by little half measures. Okay, it just doesn't work like that. It just doesn't. Okay, and so the fact that I think they're going to pivot. I think they're talking tough now, but they're going to pivot. Something's gonna happen. They're gonna talk tough. and then with the commodities prices coming down, probably end of September, early October, when the CPI numbers come out, they're probably going to come out quite low and it's going to spook the Fed. And then the Fed is going to pivot around October. That's what I think. Okay, I think they're going to pivot and get really dovish starting in October. They're setting up for that, I think. Okay, the setup is there. If the Fed really wanted to tighten they would be sending this down. Okay, a few days ago on Discord, I already posted something from Bloomberg that said that they were going to increase their treasury offering by 4 times, almost 4 times. They should be doing more of that. I mean, that had caused a little bit of a response here, but I mean, not much, right? They need to do more, in my opinion. Okay, and again, I just wanted to start out with what's on what people have been talking about is this, this type of like risk taking and companies like this, unproductive companies. I mean, really, what do they really do? Okay, I haven't met anybody that can tell me what this company makes, what they do, how they make their money, or how much they're making. No one has ever been able to tell me this about this company. Okay, so. And yet, the price of it went from $30, $40 to $2,550. That's come on, guys. The Fed is looking at this. I know they are. They're looking at this. Okay, they're looking at stuff like this and saying, what is going on? What do we need to do to stop this? All right. I don't think and also front and center, which it should be front and center on our mind because it's the front and center of the Fed's mind. Is this too? It's the U.S. dollar. I think they don't want the U.S. dollar falling too quickly. Okay, I don't think that they're gonna allow the dollar to fall too much below this. All right, that would ease financial conditions too quickly. Okay, and I just don't think that they want to reverse. I don't think they want all the hard work that they've done so far to be reversed. All right. So there you go. Mickey talked about a meme stock. Yes, I did. All right. Now, that doesn't mean, I don't know if you guys have positions. I hope to God you guys don't. But I know some of you like to play a little bit exotic. Of course, always it's after laughter, comes tears. And a lot, and whoever's long on this, I mean, you're playing with fire. If you're short, I mean, we saw what happened to GameStop shorts. This could still continue going up. Markets can stay irrational longer than you and I can stay solvent. There's a saying like that, right? You guys know that saying. This is just something that I just wouldn't participate in. But again, if this turns up like this, if HKD turns up, expect a lot more hawkish tone from the Fed. Okay, they're gonna start coming out more. And expressing much more hawkishness if this starts curling up and this starts continuing up, okay? Because stuff like this is not. This is exactly what they're trying to stop, okay? This is exactly what they're trying to stop. Excessive risk taking because of easy financial conditions, okay? That is something they want to avoid. All right. So there's your meme stock bit for the day. All right. Again, let's just go to the dollar, our dollar chart right here. We are losing our 18-day moving average, as I said. Okay, it tried to revisit that, and then it failed. All right. So we'll see. I think euro is a major driver of that. The euro is up today. It's still in this kind of range. I don't know what you want to call this. You can call this a Darvis box. If it is a Darvis box, then I guess if you assume that this is a Darvis box, then I'm guessing you're waiting for a reversal, which is often common to see a Darvis box. And if you subscribe to the technical analysis theory, of course, I think there are certain things. You know how I feel about TA. There are certain TAs that do work. I do know that there's some that do work because a lot of institutional desks use it. But I think the way it does, and this is just my opinion, of course, I do think that the way most people use TA though is pretty flawed and is not really that much different than gambling. But having said that, there are certain things that institutions do use. For example, the Bollinger Bands with length 18, 2 standard deviation. I do know that equity desks, institutional desks use that. I also know Darvis boxes are discussed a lot. So I know that some of these things are being used in institutional desks, and that's usually the ones that I use too. All right. Just because I'm also from that world, but yes, if this is, if you believe this is a Darvis box, then there is, then in that case you may be thinking that this may be a trend reversal. I'm not sure about that. I think this is more of a consolidation. I think we do see lower euro later on, but currencies don't always move in straight lines. Okay, so we've been seeing the euro coming down now for almost more than a year. I wouldn't put it out of the put it out of the realm of possibilities for this to rally a little bit and then fall back down, maybe later on next year or so, or it could just lose it. Okay, I think it's going to really depend on this winter. I think for that, you might want to look at natural gas. I know for some of us here in the United States, it's going to be very difficult to find natural gas prices in Europe. I have, I talked to Toasty yesterday after High Noon Highlights. Also, too, I talked to some of my old contacts in some of these institutional trading firms, and they're telling me right now that right now here, it's natural gas is around $8 or so, right? There's a huge premium in Europe right now. It's around $50-something or 50-something euros right now. Almost like what? That's like 6 times higher on the premiums. So right now there's a huge there's a huge premium right now because of the decreased flow of Russian natural gas. One of the things that you may want to look at, and this is something that I'm going to look at. Of course, you have me here, so I'll definitely do this research as well. But if you guys want to follow along with me, Toasty on voice chat text. We posted yesterday this link. This is the link for the aggregated gas storage inventory for Europe. And in order for Germany to get through the winter without any type of shutdowns to their industry, because they've already mentioned that if there's going to be rationing happening, that households and residential places are going to get they're going to get natural gas access first. And if there's any rationing that has to be done, or if natural gas needs to get cut from certain areas, they're going to cut it from industries first. Okay, so residents are going to get preferential treatment when it comes to gas rationing if it happens. And so in order for Germany to get through the winter with everybody open, like industries open, and residents getting their gas, their gas and storage has to be about 90% full. Okay, it has to be about 90% full. So that's probably why we've been seeing Germany. I mean, we've been seeing the European, the Eurex natural gas prices so high, because I think a lot of utilities, especially in all these European countries, are just buying indiscriminately at whatever price. Okay. Now, even if there is a shortage of natural gas, I can still see the European premiums coming down by November or so, especially if the weather turns out to be a little bit milder in the winter. So definitely, I think the European weather, the weather data is going to be very important. If we see bitter cold, if we see early cold, if we see excess demand for energy coming early, and we see that this is not getting full, I think we could see a little bit of volatility in the euro. Okay, and so that would mean, that would be good for our FEZ puts. Not really good for European residents, however. We shall see, okay? It could go up, it could go down. I mean, nobody has a crystal ball to this. So manage your risk accordingly. But my plan still stands for Europe. If the euro closes below the 18-day moving average for 3 days in a row, on the end of that third day, I will add more to my euro put position on FEZ. Okay, so just wanted to bring that to you guys. I know there were some questions about when I would enter, what constitutes like the third day. I got some DMs like that after yesterday's video, but I just wanted to make sure that was clear. Okay, this has to close. The euro has to close below this 18-day moving average for 3 days. I'm exercising a 3-day rule on currencies. It seems to be like a thing this year. Sometimes, like for example, right here, right? Sometimes it loses a pivot, like Australian dollar, for example. Australian dollar has been like, I don't know, this is one of those super volatile currencies this year. It gets over a pivot, and then on the third day it loses it. Okay, it gets over a pivot, loses it. All right, so it seems to be that you can't just take 1 day's close at face value. You need like continuation, 2 or 3 sessions in order to see that. Right here, see, up over a pivot, boom, lost it. So it seems to be that's the thing. All right. But then, when you wait for 3 days, then you risk this kind of thing. Oh, it can move like really against you, or you might just miss it altogether. If it holds, for example, all right, like here, if it closed 1, 2, 3, I mean, you're already too late then to short if that was your short signal, right? So yeah, you do risk losing out or missing out on the trade, but I'd rather miss out in this market than participate in something that goes against me and just like the rug gets pulled under me. That's just me. I think capital preservation is key right now. Okay. Yesterday I also posted on Discord too, speaking of risk management, something I didn't do. I kept it very small, but yesterday I also my IWM, I told you guys I got into the October. I forgot to cancel my November order, so I'm in November's as well. I guess it worked out in my favor because the IWM is down right now. So it worked in my favor. I'm also in the November 180, 170 put spread. I had all these different orders. I had October, November, December, all different chains, different things, with orders. And I guess I forgot to cancel this one. All of them were super small, so I guess 2 orders filled at once. Oops. Oh well. I sometimes forget. Since I've been using these really really super small positions, I've forgotten to cancel orders sometimes. It's been like a theme for me this quarter. I just orders that I forget to cancel are just hitting, but they're all pretty small, so I'm not too worried. Speaking of IWM, yes, the liquidity sensitive areas of the market are getting a bid right now. Again, like meme stocks getting a bid, or meme stocks are dropping. I'm sorry. The liquidity sensitive areas are showing cracks. Okay, there are certain cracks that are forming. Okay, yes, we are seeing HKD and all that. These meme stocks going up, but it is falling down. IWM is also weak today, weaker than all the other indices. The QQQ right now is up. The Dow, actually, let's see if the Dow up right now? No, the Dow is down. Okay, so the Dow is down. IWM is down, and then of course SPY is around break even. Okay. Just technology seems to be the strongest sectors right now. Actually, what's really strong is XBI. I was expecting a bull market, later on after one more big sell-off. And remember how I said next year we may be seeing a rolling bull market. I think there are certain parts of the market that have already front run that, and it's already starting a bull market, rolling bull market pattern. Okay. I'm not saying that sell-off won't happen. I still think that there's going to be one big drawdown in the indices, but there are certain sectors, there are certain parts of the market that are already showing signs of a rolling bull market, and one of them is XBI. Okay, look at this. XBI is just on a tear. All right, it's like as if they're front running the market. They're front running. Okay, they're just going. Okay, we shall see what happens to this. Okay. Also, too, the software sector. if you look at some stocks like Intuit, they're also showing some strength. I do think that they have one more pullback, and then they might continue up again. But I think the low may be in for software and that sector. And I also think that XBI also could be already the lows are in, which comes with my theory that IWM the low is in, because a lot of much stronger companies entered after this June rebalance. I think we may see a pullback, but and I do have those puts. But I think we come back maybe down to here, like low 170s. If we see a pullback, we'll probably, I think we'll find some support down there. Okay. Especially since, XBI, software, these kind of more liquidity sensitive areas are already starting, some of the like XBI and software and some of these like really high growth areas, they're starting to show signs of a rolling bull market. Okay, but that doesn't mean the rest of the market is going to be like that. Okay, I think most of the market is still going to sell off when, if the Fed ratchets up their hawkishness. Okay, so that's something to keep in mind. I do still think that there might be a pullback, but I think it will be shallower though in XBI and in software. Okay, but I think when it comes to some of the bigger mega caps like Apple and such, I think Apple definitely, we could see a big drawdown in some of the bigger tech names. Okay, Amazon, all right, it could come down. I mean, this could come down another 20-30%. Some of these big tech names, and when it is, the Nasdaq really is like 4 or 5 stocks, and everybody else just is just piggybacking off of them. Meta. I mean, this one couldn't even sustain a decent rally. That one, this one's, I think the end is near for this company. I think within a decade, I don't know if this is going to be around. This might be like the new AOL or the new Yahoo or whatever you want to call it. I think it's very, very good chance. A lot of their executives are just leaving the company. And for a tech company like this, that is like death by 1,000 paper cuts. All their big executives leaving. All right. Google, if the dollar goes up, Google is the most sensitive to a dollar strength. That could go down too. Although I do think that this support has kept quite well. We'll see Google, but I think most of the downward action could probably come from something like Apple or Microsoft, something that has come up a lot. Microsoft, yeah, definitely it's we could see this coming back down here. If it comes down to 251, I mean that's still about 15% or so. So we could see the QQQ. Oh, look at that! It's at our resistance line right here that I drew. Oh, interesting. Okay. I do have some put orders on QQQ. Actually, let me just make sure. Did I cancel those? No, I did not. I still have them. Okay, but I do have some QQQ orders for November OpX 305, 295 put vertical spreads. If they get to 3-to-1 reward to risk, I'm willing to enter. It gives me about 3 months or so, just enough time for the Fed to get hawkish and pivot again. So, if this drops, if Apple, Microsoft, Amazon, all these big tech companies, they drop 10-15%, I mean, this will drop 10-15%. So that takes it 10%, takes it to about 290 or so. All right, 290, 295. So that's where I want my short strike on my vertical call debits. All right. So when it gets to that around 295, 290 zone, that's where I take profit. It'll probably maybe it depends on how fast it drops, but if it takes time to drop, I'll make more money because of the gamma exposure. But if it drops very quickly, then I may be just doubling my money, a little bit more than doubling my money, maybe up to tripling it if it gets to 295. All right, or of my position. Okay, so we'll see what happens. But I think I do have an order. Do I have an order out? Yes, I do. I still have that order out The November 2022 305 295 put vertical spread. It's up to you guys if you want to join me on that or not. Okay. All right. So that's the U.S. indices. That's what I'm saying. Let's take a look at some of the bonds. Some other plays that we have. Bonds, TLT. Oh, that was frustrating. That was really frustrating. I really wanted to see this come down a little bit more to 112 area so I could get in, but we'll see. Bonds, again, slower, okay? It's harder to turn the Titanic than it is a tugboat, right? So we shall see what happens with that. Our indicator ZF. ZF also a little bit of strength today. We shall see what happens to this. Again, if this goes down, dash for cash. If this goes up, cash is trash. All right. Let's take a look. EWT. Okay, so a little bit of a bounce. We shall see if that continues. TSM, I know, is in the media a lot because of the Pelosi visit. Oh wow, $88 again. It's back up to our short zone right there. Interesting. But the rest of Taiwan is not as strong as TSM is. I think it's because TSM, they are building some new plants here in the United States, and I think there's a little bit of enthusiasm for chip stocks right now. But we'll see if that continues. Let's look at some of our data that we always look at. Give me 1 second here. All right. Let's see here. Okay. So our AD line, it's still up. But as we can see, it's starting to curl. Okay. Will it make a new higher high here? That would be that plus this New York high-low line is still not curling up. Okay, it is still not curling up. I think it had a chance. It had a chance to get above the first moving average, but it couldn't. It couldn't even do that, and it just lost it yesterday. The New York high-low line went down yesterday. All right. So, again, we're starting to see cracks forming in liquidity. Again, we're starting to see some cracks. That doesn't mean that we have to have a sell-off. I might be wrong on us having that one big sell-off. I mean, again, I'm not trying to tell us to predict the future. I'm trying to just anticipate what could happen. It doesn't mean it has to happen. Okay. I might be wrong. All right. It's just, I just have to manage risk at that point. Okay, so that's why I've been keeping my positions fairly small. All right, right now I'm at like 94% cash at the moment. All right, 94, 95. So that just tells you how much I'm focused right now on capital preservation. All right, US 30 and 10. Making a little bit of a rebound. It's not uncommon after seeing a huge move that he retraces a little bit and he can continue down. I can see that happening, or it could just keep going up. I don't know, but this is just one day. I wouldn't be surprised if it just continues down. If this is just a little bit of a dead cat bounce, if you will, just a little retracement, is coming back down. All right. Our 10-year indicator, 10-year yield indicator, which is copper divided by gold times 1,000, it's still dropping, guys. It's still dropping. All right. It's suggesting that the 10-year should be closer to 2. All right. I don't think that's what the Fed wants. The Fed, I think, is increasing their treasury supply because they don't want rates to fall down too quickly. Okay. They just don't want that. All right. That would reverse all the hard work that they've done. All right. TNX, keep an eye on that, guys. This is going to be very telling on what happens. Okay. If this really starts coming down, breaking down, and just coming down like this, I think that's the bond market's kind of signal to the Fed, hey, hurry up and cut rates. And I don't think the Fed wants to do that right now. I think they want to try and tighten more. But I think the Fed's gonna break in October. They're gonna get spooked out, and they're gonna start talking about loosening and getting dovish. TIP TLT, on the low end of the range. Again, if we see this also hugging that lower Bollinger Band and just writing it down, that's going to be the bond market's way of saying, hey, Fed, wake up, hurry up, cut, all right, cut rates, all right. Like a child that's coming on a sugar crash and it wants more sugar, all right. They might throw a little tantrum right here, all right. That is not what the Fed wants to see, okay. But we'll see. I think the Fed is now trying to send out messaging that that it needs to do more tightening. That now it comes into play about Fed credibility. I just don't think that Fed credibility is there. And I think the markets have their own mind of what they want. We shall see. But again, I just see that setup in October. I think they're going to pivot. They're going to talk tough now, and then they're going to pivot. All right. And then they're going to talk tough because of those meme stocks that I went over earlier today. So that's what I see, at least in equities. Let's look at commodities. We haven't looked at commodities in a while. Oof, look at that. Look at that. Oil, it did not come back. Remember how we said, oh, this is the top in oil? Man, I mean, hindsight's a bitch, but hindsight's 2020. But man, we just should have shorted. We should have just shorted. We should have just been aggressive with this. Remember how people were saying 200 oil later this year? Yeah, right. Yeah, fools. Okay, that's not gonna happen. All right, maybe next year. But not 200. I don't know about 200, but I do think that we might see higher commodity prices next year or the year afterwards. But for this season, yeah, this is the high. Okay. I mean, theoretically, could it get back to our 118 short level? I mean, seriously, I would put that at less than 5% chance. Less than 5% chance is going to come up to our short level. It is what it is. Oh, well. You know, sometimes we miss out on trades because of risk management. It is what it is, okay? Nat gas. All right, nat gas. Oh, look at that. Will this make an inverse head and shoulder and pop up in the winter? That would be interesting. That's a clean inverse head and shoulders too if it does that. Clean. We'll keep this. Well, I'll keep a look at that. I don't trade nat gas just because some of these movements are just really large. I mean, sometimes like this. What is that? That's like over 10 grand for one contract. That's over 10 grand movement, and so I don't sleep often, but when I do, I like to be undisturbed. Okay, so that's I just don't trade natural gas. I've learned my lesson trading natural gas years before. No more. Not for me. If you guys are adventurous, go at it. Copper is you know what's interesting, guys? Actually, I wanted to show you this. This is one of our indicators that we were looking at. Not one of our major indicators, but one of the things we were looking at from before. It's our gold to copper ratio. Remember when we were talking about the 10-year, the indicator for the 10-year, it was the flip of this ratio. It was copper to gold. Now this is gold to copper. Okay, gold to copper is a good risk on, risk off indicator that for in the commodity world, for the overall markets, risk on, risk off. And as you can see, we had that risk off signal whenever gold outperforms copper. It means the store of value metal is outperforming an industrial metal. That's usually a risk on signal. So if this goes up, risk on. If it goes down, I'm sorry. If it goes up, it's risk off. Okay, because the store of value is more in demand and relative to an industrial metal. So when it goes up, it's risk off. When it comes down, risk on. It's coming back up again, all right? On the daily chart, at least, it looks like it's a little bit of a bounce. We'll see if it's a dead cat bounce or if it actually has some legs to it. But when I look at these kinds of trends, I always like to look at the monthly, all right? I like to look at the monthly on these. When it comes to metals make much longer, slower moves, okay? The monthly, this is what the monthly chart looks like right now, All right, so it looks like as if we're seeing some of that risk-off sentiment, especially in commodities, coming back. We will see if it has legs. Okay, move index. The move index is still quite high, quite elevated. It looked like it was coming down, but look at that. If it starts coming back up again, that would be a higher low. Generally, when we see this in an uptrend, that means we have continued volatility in risk assets. Okay, when institutions, institutions, when they value stocks or cash-producing assets like dividend-paying stocks or any stocks for that matter that has intrinsic value, they use interest rates. They use risk-free. They base it off of the 10-year Treasury interest rates. But when interest rates and when bond markets are very volatile, it makes it very difficult to price those risk assets. And so you see the institutional bid is not as strong when the MOVE index, the VIX of U.S. bonds, when it starts going up. When volatility is very high in bonds, it's harder to price risk assets. And so that's why institutions, they take their foot off the pedal when it comes to bids. Okay? So just keep that in mind with this. If this is still going up, it's just trending up, well, that means we still can see a chance of volatility entering the market. All right. So that's what I see here. So again, the 30 and 10 making a little bit of a bounce. The 10 and 2 still going down. Bank profitability. That's probably why the Dow is having such a hard time. Just because bank stocks cannot participate meaningfully in any rally if these keep going down. Okay, bank stocks are a significant portion of the market, not as big as tech, of course, but it is still a major part of the market. And usually, when you want to see that market breadth, when you want to see new highs and new lows, all right, it's all connected. All of this is all connected, guys. Okay, so when you want to see that breadth increasing, all right, when you want to see, when you want to see this really take off, the advance and decline lines. You need more participation from different industries. You can't just have like a few tech stocks do well and that's it. That's not how it works. You need more participation from other industries, and you're not going to get bank participation if this keeps going down like this, if it further inverts. All right. Again, growth versus value. Growth stocks are outperforming, and so if you are going to be long on stocks, I do recommend you get into tech, just because of this. This is what it's saying here, that if we see a rally, tech stocks are going to outperform value. All right. I do think we might see a pullback here, especially if the Fed gets a little bit more hawkish. I think that's very possible that this goes back down. All right. Let's get to Bitcoin and Ethereum. Thanks to our member BZ. BZ gave us access. Here in the United States, we can't open up Deribit accounts as individuals. We have some of our friends overseas that are sending us, or last night he sent us the CSV file for some of the trades that we were looking at. And sometimes, in this view, it's kind of hard to see all of that at once. And so what I did was I missed on some of the later pages, there was a timestamp of another trade. It had the exact same timestamp as our ratio trade. Remember, it was like I believe it was the 3,500 4,000 call ratio spread that I said. I said it was a ratio spread. Well, it turns out it's more of a butterfly. Okay, and for those of you who are well versed in options, if you're not well versed in options, don't fret. I will have some more courses though in options coming out later on this year, so I will explain what these terms are. But for those of you who know the difference between ratios and butterflies, I mean, if you guys know that a butterfly, a butterfly spread is just like a 2-to-1 ratio spread, but you're protecting your downside just in case if it goes beyond your measured move. So in a ratio spread, you buy a closer to in the money, let's say a ratio call spread, you buy a closer to in the money call. All right. Let's just go to the Ether chain and let me show you. So this was done on the March chain. So let me go to that. Huh. Deribit's been kind of like this last few days. It's been kind of slow and glitchy. Sometimes it just like blacks out on me. Not sure if anybody else has been seeing that. But okay, let's go to the March chain. So yeah, so in the March chain, you know, so the ratio spread, or what I thought was a ratio spread, was they bought one of this, which was closer to in the money, and they sold two out the monies, further out the money. So the two was at the 4,000 mark. Okay, and so what I thought was happening was that they were collecting a credit. Just in case if they're wrong and it doesn't go up, they collect the small credit that they made. But if it goes up, their max profit is if by March 2023 expiration, it closes as close to 4,000 as possible. Once it gets beyond 4,000, though, they start getting into a loss. And you know, technically it is undefined risk because the losses could be unlimited. So although it is a mildly bullish position, if it keeps going up and up and up and up and up and like it just runs away, potentially you could face unlimited losses. Okay. Now what a butterfly does is the same thing. It is still, you buy this, you sell two of this, just like the ratio call spread, like the 2-to-1 ratio call spread, but you also buy another even further out the money call, so that if it runs away from you, you have defined risk. Your max loss is defined. Okay, so it's still a bullish position. It is a lower probability trade, as you have to be right. Like you have to be right in timing, direction, and the magnitude of the move, and in volatility. And volatility has to fall at the same time. Okay, so it is a lower probability move, but a lower probability trade. However, if he's right, or if that trader is right, the payout could be potentially huge. Okay, so they are betting on a drift to about 4,000, 4,500 level, and they're very, very short on the implied volatility. Okay, so it's still the I guess the flavor of the trade is still the same. It's still bullish on the underlying and very bearish on the implied volatility. Okay, it's just a small tweak. It's just an extra leg to protect on the downside, just in case if price really starts rallying and running away. All right, so it turns out it's a butterfly. All right, so somebody's putting millions of dollars into this butterfly spread every few hours. All right, let's actually see what's going on today in the Ethereum blockchain here. It seems like every couple of hours when I refresh this, it changes. It changes so drastically, so quickly. I'm amazed at how quickly this is. I mean, it's crypto, so it's a smaller market.